Hello, and welcome to the fourth video on mortgages for grade 12 Essential Math. In this one, we're going to take a look at the total amount of interest that you pay and the total amount that you pay for a mortgage, which is honestly a higher number than you think it is for a mortgage. So let's take a look. In order to figure out the total amount that you paid, what you do is you take the monthly payment times the number of payments. Pretty straightforward. If you pay $800 a month for your mortgage, and you pay it over 25 years, you say, how many times did you pay it? Times the amount that you paid. Usually, this will be for many years for a mortgage, but this principle works for any type of loan that you have, whether that's a car loan or anything else. Your total interest then, you take the total amount that you paid and subtract the principal or the amount that you borrowed. So if for a loan, say you pay $200 in total, and you only borrowed $150, well, you paid $50 extra, so that's your total interest. We did do a simple example like this in the first mortgages video. If you're curious, take a look at that. However, we can also use this to work a little bit backwards to see what we can figure out for mortgages. So let's take a look at an example here. In this case, we have someone who bought a house, and there's a little bit of details in the table here. So we have a house price, a down payment, a total interest paid, or a finance charge. You'll sometimes see that called finance charge. And there's an amortization period of 25 years. So what we need to do is, first off, we should figure out how much she borrowed. So we need to say, well, $310,000 is what she paid for the house, and we're going to subtract the down payment of $24,000, which works out to $286,000. That's her principal, or how much she borrowed. The reason we need this is because we're going to say, hey, let's work a little bit backwards. So let's go back to our formula here. I have the principal. You may notice that I'm looking for the monthly payment. I have the principal. I have the total interest. I can find out the total amount that was paid by working backwards through this formula. So let's look at that. Here's my principal, $286,000. I have the total interest paid here. If I add those together, $286,000 plus $184,200. Oopsies, there's a zero there. $184,200. I end up with a total amount of $470,200. This is the total paid, the total amount that we paid or she paid for this mortgage. All right, $470,200. However, I want to figure out the monthly payments. That's what the question is asking for. We have a total of $470,200, and that is going to be equally divided over 25 years. So I can say 25 times 12, and 25 times 12, the reason that we're going to do that is we're going to use that to figure out how many times she paid that in total. So she paid 300 times in total for her mortgage. Oopsies, that's not a dollar amount. If we take this amount here, the total that she paid, $470,200, divide that by 300 equal payments, that works out to $1,567.33. So in this is her monthly payment. We can work backwards for something like this, and this has been a question that I've seen occasionally, figuring out what the monthly payment is from the starting information here. We've got our price, down payment, interest paid. Make sure you know what you're looking for and what they mean. We needed to find the principal and then work backwards in order to find the monthly payment, and we could do that just fine. You can also do this by substituting in and using your algebra from those formulas, and that works exactly the same way. When you're looking at a mortgage and you want to figure out ways to pay less interest, a number of options that you can look at. Generally, you end up paying quite a lot of money in interest to the bank. In the example we looked at with Laura, she paid $184,000 to the bank in interest. That's a lot of money. It'd be great if you could reduce the amount of money that you want to pay in interest. Here's a couple of ways that you can do that. So you can find a lower interest rate. By doing that, you can look at possibly variable rates or fixed rate options. Those are something that you can check out. Depending on where the market is and what interest rates are doing, either of those might be an idea. Right now, interest rates are very low as I make this video, so that's something to consider. You can also negotiate with different banks. Sometimes different banks will give you different interest rates, and that's something to look at. Just be careful as you're shopping around that they don't do a hard credit check on you, because that will lower your credit score, and that's not great. Increasing your down payment is another way to do that. If you have more money, putting more money down on your house means you have to borrow less, which can dramatically reduce the amount of money that you have to pay in interest. A shorter amortization period, or paying it off faster, increases your monthly payments, but means you pay less interest. This can be quite a dramatic change, but you have to pay more each month. That might not be affordable. You can also do what's called accelerated biweekly payments. The idea behind this is if you pay monthly, you pay 12 times a year. If you cut that in half and pay twice a month, you'd pay 24 times a year. If instead of paying that amount 24 times a year, you pay it 26 times a year, which is every 2 weeks, then you pay off just a little bit more each year. And so your payments are a little bit higher, but you pay it off a little bit faster, which means you pay a little less interest. Also, if you have a lump sum, so say for some reason you end up with a bunch of extra money, you can use that to pay off your mortgage a little bit faster. And that will save you a bunch of money in the long run. However, not all mortgages are what are called open mortgages, so you might not be able to put extra money down, or there might be a penalty for doing so. Look at the numbers and talk to the bank and say, is this a good idea based on where things are? Sometimes it's a better idea to take that lump sum and invest it instead of paying off your mortgage, because you'll earn more money in the long run. Now, one thing to note, for any of these, it's always a balancing act of whether you pay less interest or pay more per month or less per month. Generally, if you want to pay less per month, you're going to pay more interest, with the exception of lower interest rate. So if you don't have the money up front, it can be really tricky to try and decrease the amount of interest that you're paying. Another thing to note is that if you're close to the maximum that you can afford, generally you'll pay a lot of interest. It's usually a good idea to not max out the affordable home price. If the bank says they will offer you $400,000 for a mortgage, if you go right up to that limit, you'll pay more interest than you want. So this is all a balancing act. What can you afford now versus can you afford it later? Do you want to pay more interest later? And unfortunately, you're not always able to choose that, because based on what you can afford, it might be great to increase the amount you pay per month because you pay less interest, but that might not be realistic depending on where you are in life. Hope this has been a little bit helpful. These are a couple of ways that you can pay less interest for your mortgage. So enjoy the video, and I'll see you next time.